Hello and welcome to another episode of Wealth Conversations. We all know that stock markets are at record highs, and we also understand that investing can be risky at these levels. Does this mean you stay away from equities and risk earning returns that are lower than inflation? Not at all. There's a category of funds, the balanced advantage funds, that gives exposure to stocks while limiting your risk. These funds are dynamically managed equity mutual funds that typically alter their equity allocations depending on market valuations. Today, we are going to talk about Nippon India Balanced Advantage Fund. And to share more details about this fund, I have with me a very special guest, Mr. Ashutosh Bhargava, Head Equity Research and Fund Manager, Nippon Life India Asset Management. Welcome, Ashutosh.
Thanks, Gitu. Thanks for having me.
Ashutosh, with markets at all-time high, volatility is increased, and we saw recent correction in small and mid caps. How important is it to be dynamic in our approach?
I think we need to be cognizant of the fact that market leadership keeps changing over time, both in terms of asset class, one asset class outperform the other, and within an asset class also. For example, broader market has materially outperformed the large cap. So maybe they have discounted a lot of positive into the future. Not as possible with this kind of outperformance over the last 15, 16 months that broader market may digest these gains. And therefore, a dynamic approach where not only you kind of adjust your weights in terms of asset classes, but also in terms of balance your weight by reducing the asset class which have probably run ahead of itself, and kind of increase the asset class where there's potentially more gain on relative basis. That should be the approach, and dynamic asset allocation would help you achieve that objective. So at this point of time, it is possible that broader market may underperform the large caps, and the dynamic approach therefore would help at this point.
Why balanced funds make sense when markets are at record high and when participants and retail investors are expecting it to go still higher?
So there's nothing wrong with all-time high and then you have to get out of the market. The real issue is that market is at all-time high, or is it running ahead of itself? And therefore, the importance of valuation come into the picture. So when market is at all-time high and the valuations are also at all-time high, that's where you need to take a step back and see whether at this point of time you need to reduce allocation to equities a bit and increase the allocation to other asset classes like fixed income and gold for the time being, so that market in terms of valuation come to a more normal level, and then again you can increase the allocation of equity further. So at this point of time, the issue is not with the market being higher. In fact, as you rightly said, we are in the midst of a bull market. It's just that valuations are slightly running ahead of its time, particularly in the broader market.
How does a dynamic asset allocation model work for Nippon India Balanced Advantage Fund, and what is the investment rationale behind this fund?
The rationale is simple that, as you understand by the name itself, it's balanced advantage. We run it like a balanced fund. The only advantage is that in a balanced fund, you can't go below 65% in terms of net equity allocation.
Right.
In balanced advantage fund, you can go as low as 30% net equity allocation, and that you can achieve by reducing the weight of net equity by hedging yourself in terms of equity futures. Now, our model is a combination of two approaches. One is the fundamental approach, another one is macro stroke momentum approach. So ours is a model where the fulcrum of the model is valuation. Like many other asset allocation models, we also believe that valuation is very, very critical when it comes to taking the signal from the market where we should be in terms of equity allocation. But at the same time, we realize that valuations are critical, but not sufficient when it comes to having a dynamic approach in terms of asset allocation. So along with a valuation parameter called 1 year forward P, we also combine it with three other variables. One is the price momentum of the market itself. So we look at whether the trend of the market in the short to medium term is positive or not. If the price momentum is positive, we increase the net equity allocation a little bit. We also look at two of the macro variables. One is trade weighted dollar index, and the other is combination of commodities like copper, nickel, and lumber. If these commodities are appreciating and in the positive trend, we again increase equity allocation a little bit. If dollar is depreciating, and as we all know, dollar is negatively correlated with risk assets. So whenever trade weighted dollar index is depreciating, again increase the equity allocation a bit. So we run it between 30 to 80%. If the valuations are cheap, dollar is depreciating, price momentum of the market is positive, and commodities like copper, nickel, and lumber are also showing an uptrend. We can go as high as 80%. And on the other way around, when valuations are expensive, dollar is becoming stronger, price momentum is waning, and commodities are also kind of softening a bit in the short term, then we can go as low as 30%. So this we range between 30 to 80%, taking the signals from all these four parameters.
Ashutosh, talking about the asset allocation, which all assets do you really invest in as far as the balanced advantage fund is concerned?
Actually, it is only two assets that we invest in this particular strategy. One is equity, predominantly into large cap, some portion is into mid and small cap. And then the rest of the portion, between 30 up to 35% of the overall AUM, goes into fixed income instrument, mainly the low duration and high quality, high credit quality instrument as far as fixed income is concerned.
Being a retail investor, how does balanced advantage fund help me lowering my downside risk?
Basically, that's the idea that, whenever market corrects, you should be in a position to reduce your drawdown. So your net equity allocation, based on the signals that I highlighted, valuation, price momentum, commodities, and currencies, based on these signals, if you can reduce your net equity allocation just before or at around the market correction, you reduce your drawdown, your overall experience improves, right? So that's the idea, to reduce the overall volatility in your journey in terms of attaining your long-term wealth creation. So your ride becomes less bumpier. That's the whole idea. So a typical retail investor, particularly those who are new to the market, must have it as a core of their overall asset allocation, because the risk adjusted return, volatility adjusted return, or what I call it, return per unit of stress, I think that is superior in this kind of strategy.
If I intend to invest, say, 100 rupees in mutual funds, various mutual funds, what allocation should go for balanced fund if I'm a new investor, and what allocation should go to balanced fund if I am a, say, middle-aged 50 years plus of age group?
So I think it's a good question, because this kind of category is more suitable for investors which are new or which are risk averse, right? And those kind of investors should have up to 40-50% of their overall AUM in this kind of strategy. For investors which are younger and which are more matured in the market, they should also have it like a core of their portfolio, and all the other risky bets in terms of other thematic or diversified funds that they have. They can have it around this core approach. So they can have it around 20-25% as a core portfolio around these balance advantage schemes. But new investor and the old investor, in terms of people who are closer to the retirement age and who cannot take a lot of risk with their accumulated saving, I think for them the share of dynamic asset allocation strategies in the overall AUM must be significantly higher.
Ashutosh, how is the basket of stocks selected by your team, and what are the key tenets of the research that goes into by Nippon India?
First and the foremost, we are extremely conscious of the quality of companies, quality of franchise that we invest in as a house. So that goes without saying that even in this strategy, the equity part of the portfolio is high quality in nature. Around two-thirds of the portfolio at any point of time is always invested in top 100 companies, and the remaining if the broader market is looking attractive, we can go up to one third, around 30 to 35% of the equity portion can be invested into mid and small cap. In terms of sectoral deviation, we don't take a lot of big deviation in top sectors like financial, IT, etc. Like top 2, 3 sectors, there is a limit in terms of how much we can deviate. And there are some good risk management practices in terms of liquidity parameters or individual stock exposure parameters that are embedded as a part of overall fund casing as far as this equity part of the portfolio is concerned. So large cap orientation, quality orientation. We are not very, kind of married to a particular style, being style agnostic and more opportunistic. But at the same time, we are very conscious that all the best tenets of risk practice in terms of sectoral allocation practices or liquidity parameters are always kept in our mind while making a portfolio for this conservative strategy or a strategy which is more suitable to conservative investors.
How often do you, alter or review the asset allocation for the fund? Because, markets are very volatile. I mean, if we go by the past lately, the small and the mid cap corrected by nearly 8 to 9% in a week's time. So how often do you review the portfolio for your this balanced advantage fund?
Portfolio we make for a longer time period, like with 2, 3 years kind of perspective. Bulk of the portfolio would be long-term in nature. As far as asset allocation call is concerned, that how much equity to be kept, so we believe in monthly rebalancing, but at the same time, at the time there are events around, and there is something which is not normal, something extraordinary which is going on in the market. We kind of jump in and alter the asset allocation in between the month as well. Otherwise, in a normal course, if it is not election month or a budget month or any critical event, we typically follow a monthly approach because we don't believe that tinkering on a daily basis add value. And sometimes you have to endure the noise and be disciplined. So monthly is good enough for us. This has been our experience for the last 3 to 3.5 years running this one.
Ashutosh, how do you design your debt portfolio? I mean, the fixed income portfolio, because the kind of interest that we've seen in the fixed income these days is quite less. So it must be difficult for you to really get into a quality debt and fixed income instruments, right?
Yeah. So even from the very beginning, we started this product in 2018. As far as our fund casing is concerned, we always wanted the fixed income part of our portfolio to provide that much needed anchor. So two things we always keep in mind. A, the duration, that the average duration of the fixed income portfolio should not exceed 3 years in general. And the other part and more critical part, we are very conscious about the quality of the papers or the instrument that we have. So around 80-85% of our papers underlying assets would be investment grade or above, less quality papers. So we don't take undue credit or duration risk as far as fixed income portion of this strategy is concerned.
As you said, the category of people who should really invest in a balanced advantage fund is the one who are fresh investors into the market, and also the people who are nearing their retirement age. What about the middle class? I mean, the middle age group. Would they be the right people to get into these funds, and what kind of allocation that should be, towards these funds?
Look, everyone wants to invest for the long term, but no one likes to draw down. The market corrects by 10-15%, no one would like it. So if you want your drawdowns to be lesser and your investment journey to be less bumpier, you want smoothness in overall, wealth creation journey. And I think journey is actually equally important, versus the destination. So I think for all kind of investor, people should consider that. And, doing it systematically with the help of model or, any systematic approach, I think that provides a lot of discipline And all what we know about market is that things are getting difficult to predict, and therefore this kind of approach will always keep you in broadly aligned to the market trends, and that is what is intended. So again, I am repeating, if you want higher return per unit of risk taken, any age group, any risk profile investor, I think this is a category to watch out for.
And do we make a lump sum investment, or SIPs can also go for balanced advantage?
To be honest, for this kind of strategy, where the model itself, the strategy itself is such that depending upon the market environment, asset location is done, you don't need to really worry about the timing, the entry into this kind of strategy, right? So that itself is done at a fund level. So depending upon your cash flow profile, or whether you want to do SIP or lump sum, it actually doesn't make any difference as such. So you don't have to really time the entry in this kind of strategy.
How does taxation work for balanced funds?
Well, it works like an equity taxation. That's the one advantage, because at any given point of time, the gross equity exposure is always upward of 65%. That is the minimum threshold you require for any fund to have an equity taxation. So 65% or above gross equity exposure, and all the hedging etc. is done through futures. So net equity allocation we can achieve up to 30% without compromising on the tax benefit that you derive, because equity taxation are always better for investors. So it has equity taxation, and we will always maintain it like that.
Mm-hmm. Ashutosh, one last question. Historically, if we see, what is the kind of returns that you usually get from these kind of funds?
So to be honest, for us, it's only been 3.5 years. What we have noticed that our returns are very similar to the large cap returns in this period, and so would be slightly lesser, to be honest. But the average drawdown or volatility is less than half of market. So you're getting returns over the medium to long term, which are equal to the large cap return, slightly lesser than that, but not very different over a longer period. But as I said, the bigger advantage is experience, and and to and the ability to withstand the volatility, because the drawdowns are lesser. So your chances to remain invested in the market for a longer term, I think you can achieve it through this kind of strategy.
Thank you, Ashutosh, for your time. It was really good insight into Nippon India Balanced Advantage Fund. Thank you very much.
Thanks, Geetu. Thanks for having me.